Hey, Sam. Oh, great. Welcome, everyone, to the Actions to Wealth uh, weekly market update summary. And I'm glad that you're here. I'm Gordon Scott, and I'm working quickly to try to get up to speed. Sorry for the slow and confusing. Hey, great to see you guys on the chat. And uh, I hope that I have something worthwhile to share today for you. If you do have any particular questions, what's on your mind, type it in and let me know what you're seeing out there in the markets and what might be coming up in ways that has got you concerned. And what are you trading and hoping to manage as you're trading? Any of that you want to, please type it in, and I'll be happy to incorporate that into my remarks today. I usually like to talk specifically about the markets, but I want to show you something that I mentioned the last time I was here. I was doing some data on what's better, breakouts or reversals to trade. And I had made the comment that it depends a good bit on what you're trading. If you're trading the euro, reversals tend to be better. If you're trading the yen, breakouts tend to be better. And so after that, I went looking for methodologies to trade the euro that could sort of work out well. And the one of the things I teach in my class is looking at the different types of trading, which I like to use the trading animals to talk about dragonfly, hunting dog, um, falcon, and jaguar, and polar bear. Those are the five different animals, and they're basically, if you Google those animals and ask Google or nowadays ChatGPT what the success rate for these animals is as a hunter, right? And then you sort of use that as an analogy for trading and trading styles. That's why I picked them. And in particular, the ones that have the higher win rates, in this case the jaguar and the wolf or hunting dog trading styles, they have more success. They tend to have more success with reversion to the mean style trading. Now they can have success with trend following as well, but of the five different trading styles, those two, if you're looking for a reversion to the mean system, or you're trading something like the euro that tends to do better with reversion to the mean and reversal style trading, then those particular types usually have more ways of being successful. And let me share this screen with you just to show you what I mean. I did this little study of dragonfly style trading. Now, dragonfly style trading is the idea that you're going to risk a lot to make a little. You're going to risk three to make one. Hunting dog strategies are you're going to risk two to make one. So with that in mind, I set up these little lines right here, and these lines are Keltner channels, and the settings are a 3 multiplier and a 3.65 multiplier. So basically, this is 2/3 of an ATR, if you're familiar with that, average true range. What if the average range is of the past 50 days or so? We take 2/3 of that amount, and that's the sort of difference in there. And the idea was, okay, when I'm up on the one side, I want to come back short the other way, and when I'm on the downside, then I want to go long the other way. And I had a whole style of trading set up for that. There's any number of ways you can do it. But my point here isn't to try to get into the specifics and the details. These numbers here are the number of trades that I had going back from current time. But I wanted to show you how it is that you could do these trades and statistically come out on top. So here's a situation where if I'm risking 3 to make 1, I should have a 75% win rate. And here, by following these methodologies, I was able to show 54 wins and 13 losses. So that's, let's see here if I can do 67 total trades and losing only 13 of them would come out with a 80 and a half. So yeah, just about an 80% win rate. So as you can see, winning 80% of the time is not going to be too much different from randomness. But that 5% difference, that can make a world of difference in your trading. Well, I mean, it makes the difference, of course, between making money and losing money. And so having a system that fits with the asset you're trading is really important. And that's just yet another demonstration of how that goes. So meanwhile, let me see if I can zoom in here and look more specifically at the euro. The euro had this big fluctuation right at the beginning, right at the end of July and the beginning of August. And I find that to be interesting because it's a little, let me see if I can get the right chart here, daily chart for, and we don't need that. It's interesting how I think I'll just do that there. How the U.S. markets and the euro both had stuff going on, but had a different kind of reaction through the same period of time. So look at this chart here. This is the NASDAQ 100. We've got 3 red candles. This one's, a doji, but the price action is expanding and then it drops down on the 1st of August. Contrast that with the euro over that same period, and we're not expanding. We're directionally heading down on the euro, but we're strongly rebounding on the 1st of August. So the fear of European tariffs really had euro traders bearish for a little bit, but just the first day after the announcements that, hey, euro tariffs may be coming, put euro US dollar traders a little bit more optimistic right out of the gate, but left US stock traders pessimistic. Now, since then, US stock traders have had a pretty good run. And so you would expect that as a result of this dynamic, that what we're seeing is just going to be, flipped and opposite. But that's not what happened. After the movement, this drop and rise, the euro has also continued higher, right? Well, I think there are 2 useful takeaways. These are things I've been saying for quite a while, and I don't mean them to be controversial. I just feel like the markets keep showing us this over and over again. The first item is tariffs are not the great destabilizer that the news media tends to make them out to be. Now, I don't, in making that statement, I'm not trying to say, oh, tariffs aren't going to have economic impact, tariffs, blah, blah, blah. I'm not trying to say any of that. All I'm trying to say is when you read the headlines and when you look at the charts as news coming into tariff implementation or clarity, approaches, you get more and more bearish behavior in U.S. Stock markets, and more volatility in currency markets, and all sorts of stuff happening. But then, as it plays out, as it's left to play out, that dissipates. It goes away. So it seems to me that the answer here is there really isn't as much to be afraid of over the Trump tariff uncertainty as people might think. In fact, I think there's a lot more opportunity in the markets than uncertainty. The second thing is the perception of uncertainty, the perception of trouble coming from the tariffs is real. And that's why I think that there is the opportunity. The efficient markets hypothesis is the markets adjust efficiently to information. A lot of people take that name, the efficient markets hypothesis, which, academia has basically said, hey, indexing is the only way. They try to take that and they mess it up. They say, oh, that means the markets are always efficient. No, that's not what it means. And definitely markets are not efficient, right? Because the whole tariff thing has showed us how we don't have efficient markets. We have markets that run up one day and then, the euro is a great example. It go running down and then running right back up immediately. And there isn't a lot that has changed through this period of time other than perception, people's perception. And so the idea that the market is efficiently adjusting to these perceptions, that's a little bit more accurate to say. But the idea that markets are going to somehow smoothly go along, or that they're always valued with the right amount, no, that can't be true. And nothing has just demonstrated that more clearly than the past 6 months. So if we know that markets are not going to move efficiently, but that they are going to adjust efficiently as perceptions change, therein lies our opportunity as traders. It might be a little oversimplified to say, hey, buy the dip nowadays. But if you had adopted that rule in hindsight over the past 6 months, you'd have done fairly well. Where are we now, though? Is it in fact worthwhile for us to consider buying the dips? Well, we just in the past week had this information about inflation. And so you've probably seen this on Forex Factory. U.S. inflation alarm bells went off again, and prices are rising, right? That's a headline from Morningstar. Well, it's interesting because now people are willing to say inflation is on the rise. But that's only because the producer price index, the sort of wholesale price costs, was much higher than expected. And that came out on Thursday. On Tuesday, the CPI came out and said, inflation's about where we thought it was. In fact, it's even a little reduced from where we thought it was. So on Tuesday, people were quite optimistic because the market seemed like it had a handle on things. But then come Thursday, and all of a sudden, we're going crazy. The expectation was that inflation should have come in, inflation through producer price indexes should have come in there at 0.2, but it came in way up here. And in fact, we haven't had a print that high for about 3 years. So all this period we just exceeded. And you think about that, what's going on there? Why is that doing that? Well, it has to do with services, actually, weirdly, not goods. Stop and think about that for a second. This number didn't get out of whack because the price of some raw materials went up through tariffs or cross-border exchange kind of stuff. Not at all. This thing went up because of services. Services are people producing their labor for various activities. And Whoa, wait a minute. That's something that ought not to. I mean, it's it's totally flexible, right? And yet this was the more inflexible part of the producer price index. So I think that really surprised people, and I think that that got them worried that in fact the, uh, the inflation might come back. But here we have the euro responding after this drop from that news with coming right back up, right back by the dip. Did I say that already? Yeah, right. So that's an interesting situation. Now, if you didn't know about it, there's this place um, called FedWatch, FedWatch tool. Whoops. The FedWatch tool is uh, something that the Chicago Mercantile Exchange and SIBO put out. Well, let's see. If you just Google FedWatch tool and you see a link that looks like this, FedWatch CME group, that's what you want. So I'm going to click on this, show you where to go, because it's a fun little tool. This tells us the next meeting is in 31 days and a few hours. If you scroll down, then you get this fun little chart. This chart tells us the probabilities for changing the interest rates, the Fed interest rates. Okay. So it tells us right here the current target rate or Fed rate is 425 through 450, 4.25% to 4.5%. They want to try to keep their overnight lending rates in that window. And these numbers here for these bars, these are the probabilities of staying at 425, 450, or doing something else. And the something else in this case is cut by a 1/4% interest rate cut. So this is telling us that there are Fed futures, Fed funds, 30-day Fed funds futures rates. That's a futures contract. And if you look at the prices of those things, it's a little wonky to try and extrapolate. This tool does the work for you and says, okay, based on the prices of those things, here is what the probabilities the traders are expressing, and so it's easy to read. In other words, the futures markets are telling us there's a 92.1% chance that we are going to see a 1/4% rate cut. The markets are sure we're going to get a rate cut. Here's what's interesting to me. Not that they're that sure, but that they're that sure now. See, I looked at this just about 5 days ago, and the number was only 85. Only. I mean, that's a great deal of certainty. But if in fact producer price index numbers were so high, so unexpectedly high, that would be evidence that the Fed should not cut rates. Because if you cut rates, you're only going to make inflation worse, right? Well, CPI, it was low, so it's like, okay, that clears the way for inflation or for interest rate cuts. But and if in fact you have interest rate cuts, then you should be really interested in investing in small cap stocks or U.S. stocks in general, technology stocks particularly, right? And so on Tuesday and Wednesday, we kind of saw the market do that. But when the producer price index blew up, I expected this number to go down from like 85 to maybe 80 or 70 something. No, it went up to 92%. You can also look up here. This is for the September meeting. But if I click on this, I can see the October meeting and say, what are the probabilities? What are the futures predicting for the October meeting? Well, it's a 55% chance for a rate cut, a further rate cut. So 41% probability is that it'll just be a 1/4% rate cut and then it'll sit there. But it's better than 50% chance that they'll do a second rate cut by October. And then in December, Fed funds futures are pricing in this, the greatest possibility or probability, 45%, is that the 2 rate cuts, that'll be it. But there's a large probability, 41%, that we'll see a 3rd rate cut. And this is really coloring what the Fed or what the markets are doing right now. Is this sort of expectation? If you're unfamiliar with this, then you're definitely going to want to, uh, you know, copy that link and be tracking it through. In fact, I'm going to put that into the chat for you. And you can, oh, I'd send it to hosts. Let me send that to everyone. There we go, to everyone. So click on that link. It'll take you to this page if you haven't found your way there already. But you're going to want to keep an eye on this because things can change. Right now, 92% interest rate or 92% probability of an interest rate cut, one, and then the others, 45%. Well, if those numbers change, if all of a sudden they go up because of things changing in new news, then you're going to see the euro become in even greater demand, or I should say the US dollar see some pressure. And so dollar denominated pairs, anything on the other side of the dollar is going to do better. I mean, that's why we've got the euro going up and US stocks both going up, because interest rate, the probability of an interest rate cut is so high. That's bearish for the US dollar and by extension bullish for the euro, and it's bullish for US stocks because technology companies and small caps companies, they can borrow at lower rates and have a better chance of growing. Well, we've got that all the way to September. That's the dynamic that is in play all the way to September. Could it be that we'll see something that will, drag the market down? Could it be that there's going to be no new President Trump tariff headlines coming out? Absolutely. There's always the opportunity for a perception to change. But unless the interest rates aren't cut, or if somehow this Fed watch tool, you see this number start dropping, until that happens, buy the dips is your strategy, at least on the euro, USD, and anything that's got the USD in the second position is more likely to have favorable returns that way, and also on the US stock market. Now, I wonder whether or not that's going to be the same for gold. Let's bring up the gold chart here. Gold has been in kind of a sideways market here for a little while. I mean, doesn't look like it's going anywhere, right? And so you might think, well, there's no opportunity. And in fact, if interest rates get cut, then markets are going to go up and gold's going to go down, right? Because the gold and the market seem to be, doing the opposite on a day-to-day basis. And yet, if you think about it, lower interest rates means lower value for the US dollar, which should translate into higher value for gold. So the idea that we're seeing gold sort of languish here is a little weird right now, especially if you consider looking at gold mining stocks. Here's Newmont Mining. This thing isn't going sideways. This thing is going up very strongly. This is one of the larger gold mining companies. The gold streamer company, Royal Gold, it's not looking the same. That's because it's working on futures and the price of gold and so forth. But even it has had this large run up just in the past 2 weeks. We look at Barrick, ABX. Is it still ABX or is it, Barrick Mining? This is similar. Just in the past couple of weeks, we've had this big run up in gold prices, or in stock prices for gold mining companies, but gold still flat, right? So some people look at this and say, hey, that is evidence that we're going to see upward pressure on gold, that it is going to move higher. And we also see silver has had more of an upward tilt than gold has over the past little bit. I mean, just here in the past month, silver's kind of sideways. But if you look at this area, it's trending up, and gold hasn't been gold's been sideways for longer than just 1 month. So I mean, I don't mean to be too overly optimistic, but I think that there's a really good chance that we will see gold and silver continue higher because of the anticipation of interest rate cuts. Any questions here before we end it up? Hey, well, thanks for attending, everyone. Until we do this again next time, take care.